Hi everyone, so we're going to continue looking at those adjustments that often come up in exam questions. And as I said, they're in two groups basically. There's the one where you're eliminating intra-group transactions, and then there's the one, there are all the others. Okay, basically. So let's look at the first type of adjustment that occurs, and that's where you have intercompany balances. So within the group, one company owes another company money. So for example, a subsidiary owes a parent 20k. That means that in the parent's books there's going to be a debtor of 20k, and in the subsidiary's books there's going to be a creditor of 20k. Okay, and as an external investor, you don't care about those balances in between them because they should net off to zero. And naturally they will do, because if you think about it, that's a debit of 20k and that's a credit of 20k. But on your financial statements, you're overstating your debtors by 20k and you're overstating your creditors by 20k. So we just need to remove them. And all we do is we put 20k here, less 20k. And we put less 20k here. Now in the exam software, if you put in the formulae properly, your total should automatically update. So what we're doing is basically debiting creditors 20k and crediting debtors 20k. The next adjustment I thought would be easy to go through is the impairment to goodwill. And under the proportionate method, it's fairly straightforward. So when you're impairing goodwill, you're recognizing an additional expense. And we must make sure that any additional expenses were occurring, we allocate the correct retained earnings. So you can either allocate to the retained earnings of the parent or the retained earnings of a particular subsidiary. And the reason I say that's important because that impacts later calculations. So in this case, it's an expense incurred by the parent company because that's the one that's buying the relevant subsidiaries. And if you have an additional expense, that's going to reduce your profit. So if you're reducing profit, you're reducing retained earnings. So you're debiting retained earnings of parent and crediting goodwill. Crediting goodwill is fairly obvious because if you're impairing goodwill, you're saying it has a lower value. Next is for fair value method. The question will tell you for the fair value method, just a reminder that this means that NCI has its own separate fair value. It's been determined maybe by an independent expert. Instead of just allocating the impairment to retained earnings of parent, you have to allocate some of the impairment loss to NCI. But I think in the exam question they'll tell you how much to allocate. That's all I just wanted to say on that. I didn't want to meditate too much on it. I've rarely seen it come up, but just maybe read through your notes and check how to do it properly. The other adjustment that can come up is where your fair value of assets at acquisition for a subsidiary is different from the carrying amounts. Okay, so when we're consolidating, when we're buying a company, we have to record the value. We have to take on the assets and liabilities at their fair value, and at the year end we present all the assets and liabilities at their fair value. Okay, now so here we have an example where the fair value of PPE for a subsidiary is 20k greater than the carrying amount at the beginning of the year when the acquisition was made, and the PPE has a remaining useful life at this date of 5 years. Okay, let's understand how to treat it. So basically this means if we accounted for it at the carrying amount, pointer options, arrow options, automatic. So if we accounted for it at the carrying amount, it means that the assets of the subsidiary are understated. So firstly what we need to do is we need to increase the net assets of the subsidiary at acquisition, because the assets are 20k higher than previously recorded. And remember, if you're increasing assets, you're increasing equity. Or if you're reducing the net assets at acquisition by 20k, you're also reducing goodwill by 20k as well. If you're increasing net assets at acquisition by 20k, you're reducing goodwill by 20k, okay? But you don't need to remember this. I'm just trying to show you the impact this is having. We do separate calculations for goodwill, but you'll see that if you're increasing net assets by a certain amount, that's going to have a knock-on effect on goodwill, because goodwill represents the difference between the consideration and the net assets at acquisition. So if it has a higher fair value, if you have a higher fair value, you need to record additional depreciation. So if it's 20k higher and it has a remaining useful life of 5 years, that's going to equate to 4k of depreciation, additional depreciation. So you have additional depreciation of 4k that needs to be recorded in the year. Now for subsidiaries, in terms of performance and in terms of retained earnings, we only care about how they've performed post-acquisition. Okay. Now, in these standardized workings, which we'll come on to, we always need to understand net assets at year end. And the net assets at the year end of the subsidiary are going to be 20k, which is the 20k coming from here, minus the 4k, which is the depreciation, and that gives us a 16k higher. So our post-acquisition movement, well, initially net assets were 20k higher, and now they're only 16k higher. So our post-acquisition movement needs to be reduced by 4k, and 4k, as you can see, is the depreciation. So if our post-acquisition movement needs to be reduced by 4k, then consolidated retained earnings needs to be reduced by 4k, and the 4k represents additional depreciation, okay? So the 20k overall was having an impact at the acquisition, but what's actually affecting retained earnings is the additional depreciation, okay? And we've shown that. Because between the year end and the date of acquisition, the 20k is still staying the same, but the only difference is the 4k. Okay, and I think we'll stop there before we move on to additional adjustments. The other adjustments are going to require a bit of time for us to go through, and I want to cover them separately in a video.